You've probably heard about private equity by now. I mean, it's a buzzword everyone seems to be talking about. And private equity is where the wealthy go to generate outsized returns and diversify beyond your standard stocks and bonds. In this episode, I'm going to explain private equity in plain English, what it is, how it works, why the ultra wealthy love it, and how you might be able to use it to grow and protect your wealth. At its core, private equity is exactly what it sounds like, investing in private companies rather than publicly traded companies that are trading on the stock market, whether it be the S&P 500 or the Russell 2000 or the Dow or whatever, NASDAQ. This is investing in privately held businesses. It's actually what happens behind closed doors, before the IPO, before the headlines, and in many cases, before the explosive growth. So if you've ever watched Shark Tank, congratulations, you already understand the basic mechanics of private equity, but imagine doing it at scale with institutional level discipline, with bigger numbers and far more due diligence. So why then is private equity a staple in the portfolios of the ultra wealthy, of the ultra rich, of multimillionaires, of billionaires? Why do they love private equity so much? Well, number one, it offers higher return potential. So historically, private equity has outperformed public markets by 2 to 4% per year annually. Now that might not sound like a lot until you compound that extra 2 to 4% over the course of 10 or 20 years. That's when it becomes a game changer. Second thing is diversification. Private equity isn't subject to the same daily volatility that we see with public markets, publicly traded stocks, publicly traded bonds. It's not priced by the hour. It's built for long-term value creation. And the third is access to undervalued deals. Private companies are often less efficiently priced than public ones. So that means the opportunity to buy great businesses at lower valuations, especially if you can add operational improvements or scale that makes the company even stronger. Like, that's a huge deal. So it's not just about chasing higher returns. It's about gaining access to a completely different playing field altogether. Now let's talk about the ways you can actually invest in private equity. First way you can do it is through direct ownership, which is also known as buying or starting a business. This would be the most hands-on approach. You own the company. You control the operations. You hire the people. You reap the rewards, but it also means you take on all the risk in one business that you bought for yourself. Okay? In my opinion, that's really best suited for experienced operators or entrepreneurs. Second way you can go about doing this is through private equity funds. And this is probably the most common route for high net worth investors. You basically pool your capital with other investors and you hand it to a professional private equity firm, and then they go out, they find deals. So they're doing all the due diligence. They're looking at the financials. They're learning about the products and services that these companies sell. They acquire and grow these businesses, and eventually they sell. They exit them for a profit. Some of the pros are this helps to diversify you across multiple companies. Because if you're just using your own capital, you might be able to go out and buy one company, maybe two companies, and then you got to figure out how to run them as well. With this, you could potentially own 20, 30 different companies, so you have some diversification. Second thing is there's professional management from a standpoint of not just doing the due diligence and trying to find the right companies to invest in, but a lot of these private equity companies, they'll send in a hired gun CEO, somebody who is a fantastic executor who can actually run that company. Third thing is it gives you access to institutional quality deals, which is what you want. These are probably companies doing hundreds of millions of dollars of revenues, employing hundreds or thousands of employees. These are sustainable businesses. These are institutional quality. Now, the cons are these things typically carry high minimums to get in, typically $250,000 or higher. Some are $1 million or higher. So that can certainly be an issue for some investors who aren't sitting on $3 to $5+ million. There's also long lockup periods. You have to walk into these things expecting that whatever money you put in there, you're not getting it back tomorrow. Your money is going to be tied up for maybe the next 7 to 10 years. So you need to size these investments appropriately. Don't overcommit. And the fees are going to be a little bit higher. They're typically 2 and 20, sometimes 1 and 10, but a 2 and 20 fee looks like this: 2% management fee every single year and 20% of profits. However, you've got great people doing the due diligence, running the company, so maybe that ends up being worth it for you. Now, as it relates to that $250,000 or million minimum, one of the great things is that if you partner with a firm like ours, that allows us to realize lower minimums per client, since our total client base far exceeds those minimums. If we look at some of these deals, we may have $5 or $10 million in some of these deals, but each client might only have $100,000 or $200,000, or maybe sometimes even $50,000 in some of these deals, depending on what we're able to broker with the private equity firm. Number 3 is private equity access platforms. So, the interesting thing is that in recent years, platforms like Moonfair, iCapital, and there's others as well, they've made it easier for accredited investors to access private equity with lower minimums. I mean, sometimes $25,000, sometimes $50,000. And what these platforms offer is fractional access to name brand private equity funds, curated opportunities where they're really trying to go out and find them and put them together and package them nicely, and professional oversight. Now, the issue is these are going to probably be a little bit more liquid, which actually means that fees are going to be higher and returns are going to be lower. So you're going to be sacrificing some returns in exchange for access at a lower dollar amount, higher fees, and all the stuff that comes with it. So how do you know if private equity belongs in your portfolio? Well, you're an accredited investor, which essentially means you have a net worth of $1 million or more, excluding your primary residence, or a qualified purchaser, which means you have at least $5 million in investable assets. If you're looking for diversification beyond public markets, this is a great thing for you to include as part of your broader diversified portfolio. It helps to reduce risk because it's a non-correlated asset class, and typically they enhance returns as well. But the greatest risk that you're taking on, which there really is no metric for, is the illiquidity that comes along with it. So look, if you want to explore how private equity might fit into your investment strategy, subscribe to this channel, like the video. I break down how the wealthy invest every single week. And if you want to learn more about how my firm helps clients access institutional quality private deals, drop a comment or DM me the word private and I'll reach out.